Hey guys, welcome back to Control Z Crypto. I've had a short break from making videos, but it's good to be back. And in this video, I want to talk about Autostakers. These are the apps that promise these really high returns, ridiculously high returns. And some of them have the backing of prominent influencers on YouTube. I've seen videos claiming these incredible profits, tens or hundreds of times their initial investments coming out of these protocols. So the question is, are you going to see the same gains as they did when you get in? So we're going to have a look at how these Autostakers work, whether they're sustainable, and most importantly, what are the best strategies that you can use to profit from them. And we're going to have a look at the four most popular ones. There are, at this stage, as these things go, there are always forks, there are new ones coming out, but we'll look at the most popular ones, and they are Titano, Libero, Safuu, and relatively new one, Sphere, and try to work out what are the differences between them and whether those differences actually make a real difference when it comes to choosing an investment strategy and in terms of the kinds of returns you're going to get. So when I started to put this video together, what I did is start to look at the contract code and do what I've done in the past with the intention of, trying to model the behavior, dig into the detail of how the contract works on kind of a micro level, and then trying to basically put together tangible predictions using some sort of model. But as I went down that path, I realized that for these Autostakers, it's actually a lot simpler than that. And there's no point producing, a complex model for something that can be understood and evaluating using just a few simple heuristics. And I think it's important, or more important, to actually share those heuristics with you and show you how I think about Autostakers and a lot of apps in DeFi. So for the first part of the video, what I'm going to do is talk in a bit of detail about Ponzinomics. Because I think that understanding how value is created in smart contracts and where that value is stored is a really important frame for evaluating not only these Autostakers, but really any DeFi protocol, because it essentially lets you predict whether they're going to be around in the long term and what sort of investment strategies are going to be effective. So we'll do that first, and after that, we're going to come back to these Autostakers, and we're going to apply some of the concepts that we've talked about to them, and to better understand how they work. Okay, so we're going to start by looking at what a simple Ponzi is, and then expanding that view to encompass more complicated Ponzi-based or Ponzi-like contracts. And which, even though they may look different on the surface, they actually function in much the same way and predictable in much the same way. So this first example is just your basic Ponzi scheme. And in DeFi, what I'm going to show you is basically analogous to the ROI apps that I've discussed on the channel in the past, apps like Stable One and Matic Staker. So get ready here, because I'm about to hit you with some really sophisticated animations. We're going to use the example of a cookie jar at first. So in these examples, the cookie represents whatever coin is native to whatever blockchain you're using. So in this case, it's representing BNB, but it could be Matic or ADA or whatever. It doesn't really matter, but just think of it as a coin and not a token, because that's going to be relevant later. So a coin is obviously the native coin of a blockchain, and a token is just a token on that blockchain. So they're vastly different, and a lot of the time it's a distinction without a difference, but in this case it does have a real difference. So think of this as a coin. All right, so say I've got a smart contract, which is represented here by the jar, and the contract is called Cookie Monster Protocol, and the balance is currently 4 cookies. So this contract promises that if you deposit a cookie, after a period of time, you're going to get 2 cookies back. Pretty simple. So along you come, you're a savvy investor, and you sense an opportunity for profit. You decide you want to double your money, so you connect your wallet and you deposit your cookie into the protocol, which increases the number of cookies in the jar to 5. Okay, now after waiting the specified time, whatever that might be under the terms of the protocol, it's time to get your return. So once again, you connect for a withdrawal, and as promised, the contract delivers its 2 cookies back to you, and you're very happy. But notice, of course, there are now only 3 cookies left in the jar, down from 4 when you first invested. But that doesn't matter to you. You're not paying attention. You've just doubled your money. So you go and tell all your friends all about this great new app that's paying out 2 to 1. And so 5 of your friends decide to invest. They deposit 1 cookie each into the jar, and that raises the total number of cookies in the jar from 3 to 5. All right, so but what's going to happen when they all want to take their profits? Well, to pay them all back 2 cookies, there needs to be 10 cookies in the jar, but there are only 8. So 4 of your friends get their expected ROI, and they're all happy. They've just doubled your money, but the last one is going to get nothing because there's nothing in the contract left to pay them. So this is essentially how a basic Ponzi works. So what's the definition of a Ponzi? What are the features that make it a Ponzi? So I think as a rule of thumb, you can remember that it promises returns greater than what you put in, and it relies on new investments to deliver returns to earlier investors. So it has no external means of generating those returns, and it's essentially a closed system. The only cookies in the example that it has access to are the ones in the jar. It can't go and invest those cookies somewhere else and loan them out and get the returns from those cookies. It's only basically feeding back what gets put in this kind of closed system. So it relies on new investors coming in to pay those returns from the old investors, and at some point the amount of new money coming in is not going to be enough to cover the amount that you need to give back to existing investors, and the Ponzi is going to collapse and a lot of people lose a lot of money, which is why in traditional finance Ponzis are illegal. But in DeFi, which is still the Wild West, they are, at the moment they're totally okay. And in fact, they underpin a lot of popular apps, and that's why being able to spot them and understand when you're looking at a Ponzi is so important. So some of you are thinking, like, that's great. We all know what a Ponzi is. What has that got to do with Autostakers? They work in a completely different way. Well, I want to expand our example to show you some more complex protocols and how they can essentially operate in the same way fundamentally, and basically they can be Ponzis with extra steps. So let's have a look at what I mean. Okay, so the second example, we'll have a look at what happens when you introduce a token into the previous example. So we'll start with our familiar cookie jar, but this time we're going to put the cookie jar into a liquidity pool. So if you don't understand what a liquidity pool or an LP is and how they work, I recommend doing some research on YouTube because they're an essential part of DeFi, and it's really valuable, I think, to understand how they work. And but to put it simply, an LP, it's a type of smart contract, and it allows the relative values to be set between different coins or token pairs without the use of a central exchange. And how they work is by basically maintaining an equal ratio of the 2 tokens or coins in the liquidity pair, so that when it has more of one, basically adjust the price by making the rarer side more valuable to compensate. So in reality, different LPs can use different ratios and different calculations to control the price, but those details are not really relevant in this model, so I'm just going to give you a simplified version. You can see from this LP, we've got 4 cookies or BNB and 4 tokens, which I'm calling T, because the amounts are the same. So there's 4 cookies on one side, 4 tokens on the other side. The LP assumes their values are relatively equal. So it sets the value of 1 T to be equal to 1 cookie. And so now this LP is connected to our Cookie Monster protocol v2, which is a new and improved version of the protocol. It wants to avoid Ponzinomics. So instead of just giving you 2 cookies back for each cookie you deposit, which, as we know, is a Ponzi, is going to deplete the reserves very quickly, what it does is it gives you 2 tokens instead, which you can then redeem for cookies at whatever the market value happens to be at the time that you want to redeem them. So once again, you sense a good opportunity for profit. So you decide to deposit one cookie into the protocol because you look at the price of T and see that you're going to make a profit. Essentially, it's going to be a 2-for-1 at the current price. So you deposit your cookie and you get back 2 tokens. All right, so now let's look at what happens in the LP when you do that, because we now have 5 cookies and 2 tokens. And if one cookie were still equal to 1 token, that would mean those relative values don't balance and you have an uneven liquidity pool. So what the LP has to do is readjust the relative values. So because there are now 2.5 times more cookies than tokens, the LP deems the tokens to be 2.5 times more rare and therefore 2.5 times more valuable. So it adjusts the price of T to be equal to 2.5 tokens. And now you, as a holder of 2 T tokens, check the price and you realize that you're now holding 2 tokens worth a total of 5 cookies each. So it would be a great time to swap them back to cookies, and that's what you do. So let's do the exchange. So you send the 2 cookies, the 2 T tokens back, and of course the liquidity pool sends you back the value that was calculated at the time of the swap, and you get the full 5 BNB or the full 5 cookies out of the liquidity pool, and you've made out really well. You made basically a 5x on your initial cookie investment out of this exchange. But you've also drained the LP, so anyone else holding those tokens has been wiped out. Okay, so of course, this is a simplified example, and you're never going to see something play out exactly like that in real life. Obviously, LPs have larger volumes for a start, and there are all sorts of other, tokenomics at play that mean this is a very simplified example. But I'm showing it to demonstrate a couple of key points that I think are important to understand. So the first thing I just want to look at is whether our new V2 cookie monster protocol is still a Ponzi. And I believe the answer is yes. So let's take another look at our criteria here. So were we promised a greater return on our initial investment? Yes, we were being offered a 2-for-1 between assets of similar value. So yes, that still holds true. And did the app have any way to sustain itself apart from the new investors coming on and adding funds back into the liquidity pool? No. The only way the price of T would remain high is if more new investors came onto the contract to deposit cookies and maintain that price parity. So both Ponzi conditions are still met, and despite adding extra features to our V2 contract, it still fundamentally doesn't change the fact that it's a Ponzi, and it still behaves as a Ponzi because essentially you've still got that store of value in the liquidity pool, and you're still delivering the returns from the contract out of that store of value. So the key, I think, to understanding all of this is to track where that value is stored in the protocol. And the first thing that you need to acknowledge is that unbacked tokens have no inherent value. So basically a token, be it that an ERC20 or a BEP20 token, basically it's just a kind of smart contract that enables a unique placeholder, an amount of which can be assigned to a wallet address. So anyone can create a token with a few lines of code and deploy that to the blockchain. They have no inherent value. They have absolutely zero value in and of themselves. So any value that a token has comes entirely from its value relative to other tokens or coins on exchanges and in liquidity pools. So when you look at contracts that are held exclusively in closed liquidity pools, the entirety of the real value is held in the other asset in that liquidity pool. So in Titano's case, that would be for the Titano BNB pair held in the liquidity pool. The value is held in the BNB within that liquidity pool. So that BNB comes from previous investors in the protocol, and as the quantity of BNB in that pool reduces, as there are more payouts, the token value also reduces. And once that BNB gone, the token becomes worthless. So it's really important to understand that that the token that is associated, with the real valued asset has no independent value aside from simply what is in that LP. So I want you to think about value from within this frame, understanding where value is stored within a protocol and how that store of value interacts with other protocols externally. Will help you identify if a contract is fundamentally a Ponzi, and I'll explain why that is important and relevant to do so in a moment. But first, I want to address some potential criticisms that I've heard before, and they generally come in two flavors. So the first is people who say, well, sure, these things are Ponzis, but in DeFi, everything is a Ponzi. That's just how DeFi works, and basically everything's a Ponzi. So it doesn't matter. You just, don't even need to talk about it. It's not a factor. Everything is a Ponzi. So that's one criticism that some people have. And the other view is that, look, this guy's making a video talking about Ponzis. He sees Ponzis everywhere. He's applying the term where it doesn't belong. And in fact, these things that I'm calling Ponzis are not Ponzis for X, Y, Z reasons. So just to address these points and really to be clear about what I'm talking about, when I'm saying Ponzis, I talking about specifically those that address or exhibit those two features that I talked about earlier. And I want to look at a few examples of things that are not Ponzis and explain why they don't fit into this model. And it's not to say that these are better investments or they're going to give you better returns or they're more profitable than Ponzi-based contracts, but it's just understanding the distinction between a Ponzi and a non-Ponzi is really important. So the first example that I'm looking at is contracts that provide some actual utility. So as an example, I've chosen stablecoin liquidity pools. And as you saw previously, there can be issues with providing liquidity for unbacked tokens, which is why I'm pointing to stable pairs only here. And the reason these are not Ponzis is that LPs take a transaction fee whenever they process a swap. And by investing in an LP, you receive part of that fee. So it's a fee for providing a service which is repeatable and sustainable. And that's where the returns are coming from. So this is not a Ponzi. The second type of contract is one that generates value from external investments. And the example I'm showing here is Anchor Protocol on Terra, and that essentially uses loans and revenue from staking and of bound assets, as well as other financial backing to generate its 20% annual returns. And the important distinction here is that the total investment within the Anchor Protocol is fully backed by the Treasury. So that means that if everyone was to withdraw, there would be enough in the Treasury to pay everyone. And essentially, if the Treasury is running low, what happens is they just reduce the interest rate to make sure that all of their deposits are covered. This doesn't rely on new investors to pay back old ones, and it has external sources of value. So this is why this is not a Ponzi. And the third example is basically the base coin for blockchains that support smart contracts. So, for example, things like ETH, Matic, BNB, etc. And like LPs, basically these provide utility by securing the network, and staking returns are propped up by transaction fees. So as long as the coin provides value by securing a thriving ecosystem of dApps, then the coin has a means of generating consistent growth. It's not a Ponzi. And the final example here, there are people who will argue that everything is a Ponzi simply because it relies, our financial system relies on constant new money flowing through the system, basically to generate growth and returns. And look, there is an interesting philosophical discussion to be had here about what underlies the world financial system and whether the whole thing is built up like a house of cards. But it's completely beside the point as far as these practical applications go. You could argue that the stock market is a giant Ponzi, and if everyone pulled out their money, it would just crash. Or you could say that a small business is a Ponzi because it relies on money constantly flowing in to sustain it. But this is not really a good use of the term. In my view, a Ponzi has specific features that are important to understand. And these more esoteric definitions don't really make useful predictions about investments. So you can make these arguments, but I just don't think it's really relevant to the question at hand. All right, so the big question here is, why is it important to understand when a contract is based on a Ponzi? And that is, again, that it's essentially paying out more than its investors are putting in, and it's relying on future investments to pay off existing investments. So why is it so important? Well, it's because Ponzi-based contracts follow a predictable pattern, and you can use if you can identify Ponzi-based contracts, you can use your knowledge of these patterns to predict future behavior and maximize returns and limit your risks. And you can avoid making, say, unprofitable decisions like playing for the long term, hoping that price action goes up in the future, because that doesn't happen under Ponzi-based contracts. So let's take a look at what these patterns are. And I've called this the Ponzi life cycle because all Ponzi contracts basically follow a similar trajectory, but of course they're not all going to be as smooth and as simple as this one. And there are always going to be various ups and downs, and short-term price rises, price falls, all that kind of things. It's very bumpy along the way. But overall, the trend is going to be consistent and predictable. On the x-axis is time, and on the y-axis is value. So for a simple Ponzi, value is what I mean by value. It's just going to be the value of the contract balance. When I've looked at dApps on this channel, ROI dApps, we've seen something very similar to this graph play out in actual reality for the contract balance graph. But for, I guess what you'd call a derivative Ponzi, like a token-based Ponzi, that value there might represent, for example, the price of the token, or it might represent, depending on how complex or weird and wonderful the contract is set up, it might represent some other source of value within the contract. All right, so early on in the contract, it's basically an accumulation phase. There are no investors to pay out. So all the new investments build up into the contract value. And as it grows, the amount that needs to be paid back to earlier investors also grows. So at some stage, a tipping point is reached, where the payouts to existing investors outpaces and exceeds the new investments on the contract. And that has the effect of lowering the overall value of the Ponzi. So this always happens by definition, and that's important to understand, because in order to maintain a Ponzi, you don't just need consistent new investments, you need basically exponentially increasing new investments, because you need to pay back an increasing number of earlier investors. So the more the more popularity the contract has, the more investors it has, the more you then need to bring on to pay those investors, because the payments exceed the ability of the contract to pay them off. So since there's not an infinite amount of money in the world, that tipping point and this kind of curve is inevitable. And once basically that tipping point hits, the contract is going to trend towards zero, and there's not really much hope of recovery unless there is some massive new uptake and some massive new investment that is going to prop it up a little bit, but then it's still going to come back down. So that trend to zero is inevitable. Now, this point here in the cycle is basically the maximum profit potential of that can be reached. So it's going to be based on the total amount that's been invested into the contract, and the higher this number, the higher your potential returns could be. Okay. Right. So say if you're going to enter relatively early, you're going to have a high opportunity for profit, because most of the life cycle, the value is going to be higher than your entry point. And this makes the opportunity for loss also relatively low. and therefore keeps your risk very low as well if you enter early. And of course, your potential rewards are going to be high as well, because assuming that the contract has a solid uptake. But if you were to enter a little bit later, you're going to see your ability to profit greatly reduced, and your potential for loss increased. And also you're going to see your overall potential returns greatly reduced. So what that means is your risk is also much higher. Of course, if you get in too late, you're just going to be left holding the bag. There's no opportunity for profit there at all. Okay, so time matters. How early you are is critical. Regardless of the overall structure of the Ponzi, they're always short-term plays. There's never an opportunity for value to increase significantly in the long term once new investment versus returns to older investment peak has passed. It's all about when you get in. So the earlier you are, the higher your potential profits and the lower your risk. The later you are, the lower your potential profits and the higher your risk. All right, so once you've identified a Ponzi, there are only really two questions, in my view, you need to ask to decide whether it's going to be profitable or not for you to invest. So the first is going to be how early you are. And depending on the contract, you might still be early enough to make a profit weeks or months after launch. I think, Baked Beans was a good example of that. There was still opportunity to make a profit long after that the app launched. But other contracts I've seen, like the Lost Simpsons ROI app, if you entered just a few hours after launch, that was already too late. So it's going to be dependent on the structure of the contract, the uptake, and basically the potential for further growth that it has. The second factor on is how much investment is going to follow you. So even if you're the first to enter a contract, there's not much new investment after you, then you're still at risk of not making your investment back. So that's the risk that people take when they jump onto one of the multitude, for example, of Baked Beans forks. It seems to happen when one of these contracts gets popular, everyone tries to copy it, and there's this fragmentation that arises, and basically none of the forks end up being as popular or as profitable as the initial for that reason. And a Ponzi needs to have new investors coming in to support it. Otherwise, it's just going to fail very quickly. Okay, so lastly, before looking at Autostakers, I just want to address the ethical questions around Ponzi. So Ponzis are illegal to operate in most places, and in some countries, in many countries, most countries, they can carry jail time for operating one. So it's not yet the case with crypto, at least in most places I'm aware of. So there's nothing legally wrong being done here. And my view ethically is that as long as people are informed investors who've done due diligence, and they should be able to invest their money as they see fit, even if objectively, when you look into the facts and the details, they're throwing their money away, they should be able to do it as they see fit. So the problem I see is that some contracts are not necessarily transparent about the underlying Ponzinomics, and they tend to complicate what their app is doing with a lot of complex and misleading terminology, and that leads investors to be misinformed, gives them false expectations about future growth and sustainability. And I don't see it as my job to try and save people for their own bad decisions, but I think it's my responsibility to point out these risks whenever I discuss these contracts on my channel. I want to make sure you guys know what's going on, what these contracts are really about. And I don't think it's really ethical to sell people dreams that are impossible. So I see influencers on YouTube tell people about the massive gains they're getting from things like Titano or Sphere. And people just basically jump on the bandwagon expecting the same outcome. But really what you need to understand about all this is that those gains, generally speaking, come because they were early, not because the contract has found some kind of secret source or some sort of magic that actually generates returns out of thin air. There's no such thing. These are, for all intents and purposes, they're Ponzi based. It's the same money that's kind of recirculating, and there's no extra kind of secret sauce in there. So that's not to say you can't make really good returns, but it's a matter of understanding how the contract works and above all getting that timing right. And I'm hoping this information I'm providing gives you the tools that you need to make these good decisions. All right. With all that being said, let's talk about these Autostakers. And again, we're looking at the big four, which share a lot of similarities, and we'll look at some of their similarities and differences as we go. All right, so Autostakers, how do they work? Well, essentially, you purchase a token and you receive what's called a rebase on that token at a regular interval, usually like 15 or 30 minutes, depending on the contract. So basically a rebase is like interest. It adds to the amount of the token that you hold, and the amount of return that you get on that rebase for these Autostakers tends to be astronomical because those rebases are constantly compounding, and usually it's in the order of 1% or 2% per day, but that all adds up, and the annualized percentage yield, or the APY, ends up being somewhere in the hundreds of thousands of percent every year, which is a massive number. But the important thing to remember is that this APY is on the token. It's not on the coin that you use to purchase the token. And because this rebase is also continually adding to the supply of tokens, it's also constantly devaluing the token by increasing the supply relative to the partner coin in the LP, as we saw in the previous example. So the other key features that a lot of Autostakers have are controls that they use to try and regulate the price of tokens to try to counteract that inflation that is caused by the rebase. So the first of these is a high buy and sell tax, usually somewhere between 10 and 20%, but I've seen higher in some cases. And this is actually a really interesting innovation because say you invested $100 with a 20% tax both ways, you're only getting $80 worth of tokens when you buy, and say if you sold the same day, you're only getting 80% of that value, which is going to be $64. So essentially by imposing this tax and assuming all other things like the token price being stable and equal, you're both counteracting that high APY in the short term, and you're also disincentivizing people from selling because they need to make that money back. In the case that I just mentioned, that's $64. They need to build that up to $100 first, which is 30% gain. And on top of that, they need to make back some profit before they sell. So in effect, that has the effect of stabilizing the contract in the early term and helping to drive that value up and drive that token price up in the short term. So another common feature that these protocols use is they use additional contracts like a treasury and what Titano calls a risk-free value. Both of these serve a more or less similar function, which is to hold some of the value that's been obtained through taxes and basically hold it in a separate contract so that at the discretion of the contract owner, or depending on the contract, it could be an automated process, that value can be placed back onto the LP in order to prop up the token value. For example, when there are large sell-offs and the price tanks, they can add some more of that value back into the LP to try and lift the token price. The other method that they commonly use to control the token price is token burns, and tokens are usually taken out of the LP in order to reduce the supply and limit the price. So let's take a look at how these elements interact and whether these measures are effective at removing the potential Ponzinomics and making these protocols good long-term plays. All right. So firstly, let's take a look at the API because I think it's important to get your head around what these numbers really mean. And we'll use Titano as an example. Titano has 102,000% APY there. So what does that mean? So if you were to invest $1, one simple dollar at that interest rate, after 1 year you'd have $1,025. After 2 years, you're going to be a millionaire, over $1 million in just 2 years from a $1 investment at that interest rate. After 3 years, you're going to be a billionaire from your $1 investment. And after 4 years, you're going to be a trillionaire. You're going to have basically $1 trillion on top of what some of the richest people on earth already have. And in year 5, I don't even know what to call this. This is more money than potentially has ever existed in the history of the world. So obviously, just looking at these numbers, none of this makes sense from a sustainability perspective. And the returns from Titano, this 102%, is relatively modest when you look at some of the other contracts. Libero, Safuu, and have much higher returns. Sphere maybe even more modest at a mere 99,900%. So how does it work? How is it sustainable? Well, it's because the returns are not paid in actual value. You're getting paid in tokens. And remember, the value of the tokens is only relative to the value of the currency pair in the LP. And the LP is where that value is. So don't forget that. These tokens never lose sight of where the value is held in these contracts. So you might work out from these figures, which are based on the single dollar, it's going to be pretty hard for these things to be sustainable. So, all right, next step, let's try adapting the Ponzi model we talked about to the Titano ecosystem. So here's our familiar LP from the earlier example, filled with some BNB cookies and some Titano tokens. But attached to the platform, we also have a treasury and a RFV. Okay. And here comes our investor. So he's going to invest some BNB and he's going to get some Titano in return. Okay, but what the contract does at this stage is basically send a percentage of the BNB that was taxed out into the treasury and into the RFV, so it can be held in reserve. And the intention being that at a future time, when the relative supply of Titano has become too high and the token value is too low, as we see here in this image, basically the idea is that those funds flow from the treasury, the risk-free value, pump back into the LP to stabilize the price. Okay. So let's identify where our stores of value here. And basically, you can see they are everywhere that is holding an actual asset of value, which is BNB. They're going to be the LP, the treasury, and the RFV. And notice that regardless of how much BNB we're moving between these stores of value, the entire ecosystem is a closed system. So all the money originates from the investor and is simply being moved from place to place within that closed system. So those movements are going to impact the token price in the short term, but they don't affect the overall Ponzinomics of the platform as a whole. Even when tokens are burned, in order to temporarily change the balance in the liquidity pool, it can result in short-term increases in the token price, but it doesn't change the overall value stored in the system. So when people are exchanging their tokens for BNB, the value in the system is decreasing, and because it's based on a Ponzi, aside from controlling the price in the short term, the measures actually do nothing in the long term to affect the long-term sustainability of these projects. It's essentially fundamentally the same type of system that we looked at in the simple Ponzi. You have the contract balance, or you have the jar, you have a certain number of BNB, and when that BNB is gone, it is a very similar system here with a lot of extra steps, a lot of complexity, moving things from one place to another, but the end result is the same. The store of value is a closed system. It relies on new investors coming in to continually pay back existing investors, because those existing investors are constantly rebasing and constantly getting rewards that at some point need to be paid back. All right, so when evaluating all these price control measures, the risk-free value, burning and so on, the key question to ask is, does the price control actually increase the value in the system without relying on new investors? And the answer when it comes to the functions of the Treasury, the RFV, burns that we've looked at is no. They merely shuffle the value around, or they create a temporary shortage to change the price on a short-term basis. Now, there are other methods that these platforms use, such as Libero's smart bonds and Safuu's auto liquidity engine. Essentially, they're no different in outcome to the ones that we've talked about here in the RFV, in the Treasury, and in Burns. So I'm not going to cover them in detail. Essentially, the point is, if you're not introducing external value, you don't change the underlying Ponzinomics, right? So let's have a look at potential external sources of value, because some of these platforms do have differences in their rebase frequency and return rates and how they implement price control measures, but none of those things really affect the overall investment proposition and remove the Ponzinomics. So the only question in my mind is whether they can overcome those underlying Ponzinomics by creating value from an external source. And some of the platforms do offer solutions to these problems, so I want to take a look at those. Now, Libero has implemented a process they call farming buyback, where basically funds from the RFV are bridged to other chains and invested into high APY farms. So the profits of those farms then get returned back into the RFV. And so essentially that RFV grows and it can fund the LP and try to stabilize the value of the token. So Libero claims this is going to grow the RFV at a rate of 100% a year. So obviously they're expecting 100% returns on their investment out of these high APY farms that they're going to be investing here. So there are a couple of problems here that I see. One is that the RFV is comprised of 5% of all buys and 10% of all sells. So it's really a fairly small percentage of the contract value overall. And so let's say you can grow that small percentage by 100% every year, which I think is highly questionable, but let's assume it's true. So you've got roughly 15% of your contract growing by 100% each year. And meanwhile, you're paying your holders in somewhere in the order of 160,000% in that same time frame. So look, whatever you make out of that farming buyback fund, it's not going to be anywhere near what's needed to sustain Libero. It's a drop in the ocean. It's going to do nothing to counteract the massive returns that you're actually paying back people onto the contract. Now let's look at Sphere. Sphere has an interesting idea. What they're hoping to do is do governance token acquisitions. They want to use treasury funds to buy governance tokens, and they hope that those tokens are going to generate really high returns. And this theory is based on what's happened with the Curve protocol on Ethereum, where there's a lot of competition to be listed on that protocol, and basically new contracts wanting to get on essentially pay tributes or bribes to governance token holders in order to be listed. So what Sphere is hoping is that this kind of thing become more widespread and become the norm across DeFi, and they speculate that this is going to be profitable, that if they acquire a lot of these governance tokens, they will be the ones who will be receiving these tributes or bribes to be listed on these protocols. So my view of this is that it's a really interesting idea, and I don't, to my knowledge, it's not something that's really been tried. It's something that they are predicting will have the effect that they expect. But in my view, it's highly speculative, and it's important to remember that until Sphere implements these measures and demonstrates their effectiveness, you're essentially just investing in an autostaker with a highly speculative promise attached, right? So right now, what Sphere is an autostaker with the same shortcomings and Ponzi-based value as these other autostakers, But it has this promise attached that in the future, maybe it's going to become profitable or sustainable based on this new investment coming from governance token acquisition. So next, I just want to have a look at how we can evaluate the effectiveness of these external sources of value. Are the promises being made by Libero or Sphere, are they going to come to fruition? Are they reasonable? Is it reasonable to expect that they're actually going to affect the profitability and sustainability of the contract? All right, so I've got a couple of simple rules of thumb that can help here when evaluating this. So we're talking about external ways that these contracts are looking to maintain the value within the contract, given that it is essentially Ponzi based. And the questions that I have, and basically, number one is the measure itself profitable. And what I mean by that is, does that measure generate value in and of itself when not attached to the contract? So in the past, I've looked at the BCT token for baked beans, and I've been skeptical that it's going to be able to sustain the baked beans contract, because in order for you to take a percentage of profits from one contract and from an external source and funnel them back into the initial Ponzi scheme to sustain it, that external source needs to itself to be able to generate more value than it can be put in. So that is to say, it can't be a Ponzi. It has to be profitable in itself. Otherwise, you're using one Ponzi to pay another one in effect, or you're just creating a second unsustainable contract to feed an unsustainable contract. So in order for this to work, you need that second contract to be profitable. It needs to be able to run by itself, generate a profit, and that profit feeds back into the contract. So that would be the Autostaker. So if you believe that these two methods from Libero and Sphere, that they can generate these consistent non-Ponzi based profits because they have some way of creating that external value or extracting real value from elsewhere in DeFi, then that makes me ask this follow-up question, and that's, why not just invest into that instead? So if you found something that consistently generates great returns, real value, that's not a Ponzi, why not just do that and not have that Ponzi in the first place? Why have an Autostaker that generates astronomical returns that can't be sustained, and then try to feed something profitable into that? Why not just create that profitable contract in the first place and use that as your basis for returns? So if, like Libero claims, they can produce an ROI of 100% per year out of their high risk, high yield liquidity pools, and that's where the real value of Libero comes from, I'd be very happy to invest in just that portion of the contract and forget about the hyperinflating Libero token. It just doesn't make sense to invest in Libero when there is attached something that is actually very profitable, generating 100% returns per year. That's point one. But point two is, is there anyone who is making consistent 100% gains by investing in risky high yields LPs? All of this seems extremely questionable. In the case of Sphere, if cornering the market on governance tokens is such a valuable proposition, then just do that. Why attach that to an Autostaker? Why dilute the value that you're creating by essentially feeding a protocol that is by nature unsustainable? So to me, all of this is basically saying, don't worry guys, I'm going to change the world. I'm going to revolutionize DeFi with these highly profitable contracts that are just going to make money hand over fist. But look, I'll do all of that later. In the meantime, just invest in my Ponzi and that'll all come in the future. So look, I'm not going to take these claims at face value. And for me, the Occam's razor approach is just simply not to trust them until all of these claims are demonstrated. So in the case of Sphere, I've heard all sorts of things like they intend to do in the future that may or may not be revolutionary, and it's all up to you as an investor whether you want to believe those things. And if you do believe them, if you think that based on your knowledge of DeFi, that yes, governance tokens are the future, and this is really going to result in massive investments, then by all means you should invest. But if they turn out to be true, it could be massively profitable, But I've explained why I'm skeptical, and the reason I'm skeptical is that I just don't understand why, if that's the profitable part, why wouldn't you just do that? And why would you have, why would you have the Autostaker underlying that and as your basis? It seems to defeat the purpose of what you're trying to achieve. But time is going to tell on that. So, look, the second question I have here when evaluating external value is the amount of revenue funneled back to the platform enough to overcome its Ponzinomics? And why is that important? Again, when you have a Ponzi, it needs exponentially, or needs constantly increasing new investments to sustain it. And you're then basically, impacting your external source and forcing it into these also to be increasingly growing in order to be sustaining that Ponzi. So again, for both the Libero and Sphere, even if these external measures end up being profitable, is this going to be enough to pay back all of the people who are on those contracts holding the bag because they got in too late or they didn't sell soon enough? How are you going to generate that much profit by allocating such a small amount of capital out of the RFV and out of the treasury to these measures? So the only way is that if farming buyback or governance token acquisitions are massively profitable and they generate huge amounts of revenue. Remember contracts like Titano, we've seen massive market caps in the hundreds of millions of dollars. So if you can generate that kind of revenue, hundreds of millions of dollars, you're covering all of these really massively high yields out of these Autostakers. Why not just do that without the Autostaker, which itself generates no value for investors? It's fundamentally based on a Ponzi. All right. Okay, guys, let's wrap this up. So what have we learned? Autostakers, they rely on Ponzinomics to deliver returns. When you break it down, the size of the APY and the price control measures, they can affect the timing of the returns and they can have short-term impacts on the price. But as with any Ponzi, all that really matters is the volume of new investments, because they're paying off the extremely high APY for existing investors. So can you make money from Autostakers? The answer is yes, but Ponzi strategies apply. And that means basically get in early or get wrecked. The later you are, the higher your risk is going to be, and the more likely you are to lose your money. And remember the Ponzi life cycle. These are not contracts, or these are not protocols that improve with time. If you think of them like like a coin or like another publicly traded asset on an exchange, you're going to end up pretty badly off, right? These are not. I've seen a lot of people basically saying, "Oh, the market's down. That's why Titano is down. It's going to come back up." This is not how it works. These are going to go to zero. They're on a trajectory to go lower and lower, and with the returns that they're putting out, there's just no way to stop them. The earlier you are, the better. The later you are, the more likely you are to lose your money. So, look, a lot of the guys who have made tons of profits, they're making it because they got in really early, like many on day one on the whitelist. They buy at a really low cost, and then once it goes public, the token does a 5x or a 10x, and all of a sudden, when the token does a 5x or a 10x, those 10-20% fees don't matter. So they sell. They make a huge profit and they sell. That's how it works, exactly how a Ponzi works, not by creating long-term value, but by generating just short-term gains for early investors. If you believe you're getting long-term returns from things like Titano or Libero, Libero is the big one in their documentation for talking about lifelong returns and setting yourself up for the future. Look, if you believe that, you're going to be the one left holding the bag. And final point of conclusion is to be skeptical of what sustainability, be skeptical of these sustainability measures. A lot of them are just marketing spin, and more than that, they're there to confuse the issue. You know, we've seen this all over the place in Ponzi-based DeFi, talking about token burnings or moving funds from the RFV or treasury. If you don't look at the numbers and if you don't think about them in the frame that I've kind of shown you about looking for the store of value on these contracts, you might think that these are keeping the contract sustainable, but you got to realize that there is just this finite source of BNB or you know, whatever it is on the treasury. So whether they're burning tokens or moving funds from the RFV or the treasury, they simply can't create BNB or Matic or Phantom or whatever out of nothing. None of that. So none of that movement, none of that burning is going to change the basic Ponzinomics of the system. There's that finite value in the system, and that only changes when new investors come in, and that's why it is Ponzi based. So be skeptical also of any claims that these contracts are going to revolutionize DeFi in one way or another in ways that haven't just simply been demonstrated yet, or ways that kind of defy, I would say, defy belief, because they haven't been demonstrated anywhere before in DeFi. So, you know, if you come along and say we're going to do this thing that's never been done before, that's one thing. But if you're promising that that's what's going to sustain your contract, I think you're probably in for a bad time. So until they're demonstrated, these are promises, and you got to recognize that they're promises. You can believe them or you can not believe them. And if you believe them, again, by all means, you should definitely invest if that's what you want to do. But, you know, I'm going to warn you against taking them at face value. Promises are really easy to make, and especially in DeFi, there's very little accountability. There's very little downside for not following through on your promises, and it's easy to make excuses. So again, if it were profitable if it was so profitable to make money, you know, through these measures, they would just do them in the first place. Like if you were going to make so much money out of, you know, for example, these high yield farms, why wouldn't you just do that? Anyway. All right, guys, that's it. I really hope you got something out of this video. I think it made sense to me to put all of this kind of frame into one video and explain how I approach my investment decisions and how I approach thinking about these contracts, because I think that's more valuable than just looking at the numbers without really kind of explaining all of this kind of background. It helps provide, as I said, provide that frame of how to look at and evaluate these various contracts. So look, if you did get something out of this, I really appreciate if you hit that like button and subscribe if you want to see more content. And apart from that, stay safe. It's a crazy DeFi Wild West world out there. So thanks a lot for watching, and I'll see you in the next video.